Some of the most sophisticated investors don't sell at random. They sell when markets feel unstoppable. And right now, that window is opening again. In 1999, it was the dot-com boom. In 2021, it was the tech and SPAC frenzy. And now, many of the same ingredients are lining up for 2026. This isn't speculation. In fact, according to research from the National Bureau of Economic Research, IPO volume is positively related to recent market returns, meaning companies tend to rush public after markets have already surged, when valuations are stretched and investor optimism is highest. So this isn't a coincidence, it's a documented cycle. Over the next few minutes, I'm going to show you a pattern that's only appeared twice in the last 25 years, and both times it came right before major market drawdowns. When central banks inject liquidity, asset prices rise, optimism peaks, and insiders find the perfect moment to exit. Let me show you how this actually works. The mechanism of smart money exits. When an economy shows weakness, central banks inject money to prevent collapse. This floods the system with new dollars. Those dollars chase the same assets, driving stock prices higher. But the underlying problems haven't been solved. They've just been covered over with cash. Rising stock prices create the appearance of wealth. People feel richer. They're willing to pay more for investments. As optimism builds, valuations disconnect from earnings. Investors start betting on future growth rather than current profits. This is when founders see their perfect exit window. Founders aren't raising capital out of desperation. They're selling when public markets will pay extreme prices for AI and space companies. They're timing their exits to market conditions, not to business needs. The window isn't perfect because valuations are justified. It's perfect because there's enough demand. Insiders can unload billions of dollars worth of shares, and these insiders know far more about their companies than you do. And this isn't just theory. According to academic research on IPO cycles, macroeconomic factors and investor sentiment explain the clustering of IPO markets. In other words, IPOs don't happen randomly. Companies tend to rush to market together when liquidity is high and optimism peaks. That's exactly the environment insiders wait for before making their exits. SpaceX is targeting a $1.5 trillion valuation. That means the total value of all shares combined. It would be one of the biggest first-day company values in history. The price multiples would be extreme by historical standards, and SpaceX hasn't even filed public financials yet. So ask yourself this. If SpaceX is such an incredible long-term investment, why is Elon Musk selling shares to you right now? Why not hold them for the next decade? OpenAI is targeting a $1 trillion valuation. That makes it one of the most richly priced offerings in history. Now think about this. If AI is going to transform everything, and if OpenAI is going to dominate, why are the insiders selling? The people who know the most about the company are preparing to sell to people who know the least. The answer is simple. They see something coming that makes right now the perfect time to exit, and that something is the same conditions that have appeared before several major market downturns. The 1999 pattern. In the late 1990s, the internet created genuine technological change. The underlying innovation was real. But that didn't stop the bubble from forming, and it didn't protect investors from losing everything when it burst. The Fed cut rates after the 1998 crisis. This pumped liquidity into markets. Cheap money flooded in right as internet companies were going public. This created insane conditions. Any company with a website could raise hundreds of millions. Revenue didn't matter. Profitability didn't matter. In 1999 and early 2000, hundreds of internet companies went public. They had minimal revenues. They made aggressive promises. Their valuations weren't tied to earnings. Investors didn't care. The narrative was simple: grow first, profit later. Pets.com went public in February 2000. They raised cash in the frenzy. 9 months later, they declared bankruptcy. A famous example of how fast sentiment reversed once the bubble burst. Webvan raised about $375 million in its 1999 IPO. Valuations were in the multi-billion-dollar range. By 2001, Webvan had collapsed. They burned through cash and expanded too aggressively during the bubble. eToys went public in May 1999 at $20 per share. On the first day of trading, it rose to $85. That gave it a valuation higher than Toys R Us. This despite having a fraction of the revenue. By March 2001, the stock was worth pennies. The company was bankrupt. The pattern was identical. Fed printed money, cheap capital flooded markets, optimism peaked, companies rushed to IPO, retail investors bought the story, insiders sold at the top, and within 18 months the companies either collapsed or traded at a fraction of their IPO price. The Nasdaq Composite fell 78% from its March 2000 peak to its October 2002 low. $5 trillion in market value disappeared. Many dot-com IPOs became worthless. Pets.com, Webvan, eToys, but the founders and early investors who sold during the IPO window in 1999 and early 2000 kept their money. They exited before the music stopped, the 2021 repeat. In March 2020, the Fed cut rates to zero. They printed trillions of dollars to prevent economic collapse. This pushed asset prices to levels that made 1999 look restrained. By 2021, hundreds of SPACs launched. They broke all previous records. SPACs were essentially companies that raised money first and found something to buy later. This removed even the basic due diligence that traditional IPOs required. Rivian went public in November 2021. They'd raised $12 billion. In the days after listing, Rivian briefly topped $100 billion in market value. They delivered almost zero vehicles. They generated almost zero revenue. But the story was compelling. They were building the electric truck that would compete with Tesla. Coinbase went public in April 2021. The reference price was $250. It opened at $381. On day one, it briefly hit $357. Then the crypto market crashed. By 2022, Coinbase traded around $40. Bumble, Roblox, DoorDash, and Airbnb all went public in late 2020 or 2021, all at peak valuations. Some of these companies have legitimate businesses, but the timing of their IPOs wasn't coincidental. It was strategic. Management and early investors saw that conditions were perfect. They could sell shares at prices far above where they would trade once money printing stopped. The 2020-2021 cycle saw a wave of IPOs in technology and related areas. Many traded well below their issue prices by 2023. This left late-cycle IPO buyers sitting on large losses. This wasn't bad luck. It was the inevitable result of buying at peak valuations during peak optimism, funded by peak money printing. The math favors sellers over new buyers, especially when valuation, issuance volume, and speculative narratives all spike together. Smart money knew it, and this is where the cycle quietly shifts, not when prices peak, but months earlier, when insiders begin positioning their exits. And here's the part most people miss. Why smart money sells at the top. When the Fed prints money, asset prices rise. This increases valuations on paper for private companies considering going public. When stock markets are rallying and investor sentiment is optimistic, there's enough demand. Billions of dollars worth of shares can be absorbed. Insiders can dump their holdings without crashing the price. Here's the timing element most people miss. IPOs have lockup periods, typically 6 months. Founders and early investors can't sell their shares during this period. So if SpaceX and OpenAI go public in mid-2026, insiders can't sell until late 2026. That's right around the midterm elections, when uncertainty typically peaks. Market researchers have documented a pattern. Equity returns vary across the 4-year U.S. presidential cycle. Midterm periods often show weaker performance. Data going back to the 1930s confirms this. Markets have historically underperformed in the second year of presidential terms. This means you get a convergence of selling pressure right when markets are most vulnerable. Smart money isn't selling because they need cash. They're selling because they recognize that current valuations are unsustainable. They know the money printing which created these valuations is temporary. They understand that waiting another year or two means risking large drawdowns. Drawdowns like those seen in prior cycles. The basic math is simple. There are already thousands of publicly traded companies. They have years of audited financial statements. They have proven track records. So why would a brand new IPO with no track record deserve more attention? Why would it deserve a higher valuation than companies that have been operating transparently for decades? It doesn't make sense. It doesn't, but during bubbles, new is always more exciting than proven, which is why retail investors chase IPOs while smart money uses retail demand to exit. The three-stage pattern. Many major market tops tend to follow a similar sequence, and we're currently in stage 2. Stage 1 already happened. The economy showed weakness. Banks needed reserves. The Fed responded by announcing reserve management treasury bill purchases. They totaled about $40 billion in the first month. Repo usage was elevated. Here's what this means. If purchases stay near this pace for an extended period, hundreds of billions of dollars of reserves could be added over a year. Though the duration isn't guaranteed, banks are tapping emergency funding channels. This underscores that stress in short-term funding markets has already elevated. This forced the Fed to restart aggressive operations, even though they said they wanted to keep policy tight. Stage 2 is happening now. Central banks are expanding reserves. They're lowering perceived funding risks. The immediate effect is a reach for risk assets and rising valuations. This happens even if underlying economic fragilities remain. New money is flooding into markets. Stocks are rallying hard. SpaceX, OpenAI, Anthropic, and Databricks are openly preparing for IPOs. Their valuations would have been unthinkable a decade ago. Giant, highly valued IPOs tend to cluster together. They occur late in bull markets when enthusiasm and liquidity are both abundant. Stage 3 is coming, major IPOs launch. Excitement peaks as stocks pop on their first day of trading. Retail investors ask, "Did you get an allocation?" as if being allowed to buy shares is a privilege rather than a risk. Then 6 months later, lockups expire. Insiders sell, the music stops. Historical episodes show a pattern. Intense new issue activity clusters near major peaks in speculative cycles. The late 1990s dot-com boom did this. The 2020-2021 tech surge did this. Both saw subsequent falls that left late-cycle IPO buyers with large losses. The mechanism that drives the crash isn't about the quality of the companies, it's about the timing of exits and the reversal of money flows. The final pattern. In both the late 1990s and 2020-2021 episodes, insiders used buoyant conditions to cash out. Early investors did the same. Meanwhile, retail investors bought into stories. Stories framed as the future and different this time. This created conditions where founders got rich. Many late-cycle buyers suffered large losses. In 1999, the pattern unfolded like this. Fed prints money. IPO frenzy launches. NASDAQ rallies to unsustainable levels. Insiders sell. Money printing stops. NASDAQ crashes 78%. $5 trillion disappears. But founders keep their cash. In 2021, the pattern repeated. Fed prints trillions of dollars. SPAC frenzy launches. Stocks rally to absurd valuations. Insiders sell. Money printing stops. The vast majority of IPO buyers lose money, but founders keep their cash. In 2026, the pattern is setting up the exact same way. Fed restarts aggressive liquidity operations. Trillion-dollar IPOs rush to market. Stocks rally to peak valuations. Insiders prepare to sell. Retail investors arrive at the top, believing this time is different because AI changes everything. The data support a cautious reading. Mega-cap private companies in AI and space are preparing to sell shares. They're selling into a market inflated by fresh central bank liquidity, in a manner reminiscent of past late-cycle issuance waves that preceded significant drawdowns. The smartest people in the world aren't selling because they're pessimistic about technology. They're selling because they understand market cycles. They recognize when valuations have disconnected from fundamentals. They know the perfect exit window doesn't stay open forever. For most individual investors, that argues for focusing on already listed companies. Companies with proven earnings and verifiable track records, rather than treating every high-profile IPO as a must-own ticket to the future. Recognize that your role in a frothy IPO is often to provide an exit for earlier, better-informed capital. The data shows this with perfect clarity. two IPO frenzies in 25 years, both near market peaks, both followed by severe drawdowns and widespread losses among late-cycle IPO buyers, both perfectly timed to Fed money printing cycles, both creating conditions where founders got rich while many late-cycle buyers suffered large losses. 2026 is shaping up to be the third time this pattern completes. The warning signals are flashing red for anyone paying attention. Markets don't crash because technology fails. They crash because liquidity reverses, and insiders finish selling before most people realize the cycle has turned. The dot-com boom and the 2021 surge weren't accidents. Both were driven by easy money, peak optimism, and perfectly timed exits. You don't need to predict the exact top. You just need to recognize when risk is being quietly handed from smart money to everyone else. So don't chase what's loud. Don't assume this time is different. And don't confuse innovation with valuation. If this helped you see the market differently, subscribe for more breakdowns on cycles, liquidity, and real risk signals, so you stay ahead of the crowd instead of becoming exit liquidity.